you know, you put your investment prism on and you look at them, and what do you see?
Well, I mean, in terms of the actual number, it is a good number. You know, I think when we look year on year, we are more optimistic on the Chinese economy and GDP growth than I would say most analysts, and certainly higher than what the state official target is at 5%. We're somewhere more around 6.1% for the year, which is a much higher number than consensus at 5.5. So I think the summary is that we're tracking along nicely. You know, there is this kind of difference between industrial output versus consumer spending. But, you know, this is going to be a consumer-driven recovery story. Household savings are still very, very high in China. And you also have a pretty pro-growth People's Bank of China with total social financing on the rise. So it all looks relatively good at the moment. Maybe not enough to convince a lot of investors to move back.
Well, that's exactly what I wanted to talk to you about, because JP Morgan did this survey and found that, you know, with the reopening here, and they investors are asked about what it would take for them to buy risky assets. Now, less than 6% voted for better than expected Chinese growth, and 56 selected falling U.S. inflation and a pause in central bank tightening. You're not surprised by that, but, you know, there is an unwillingness to invest, isn't there?
Certainly, yes. You know, if you look at the actual investment flows that have moved into Chinese equities, you know, obviously we had a big surge in sort of November, December coming out of this. We saw that was mostly driven by active funds, hedge funds, particularly in the ADR space. But, you know, moving back into onshore Chinese equities, there is still this geopolitical overhang. And what it's going to take for investors to move back, I think that will be more around the earnings story, a pickup in earnings growth. And also, we've seen this rotation, I think we spoke about this last time, but this rotation into the periphery markets, South Korea, Taiwan, which are big trade partners of China. So investors can get exposure to the reopening story without
going. If they want to. Anyway,
yeah.
There seems a reluctance.
Tom, what do you make of the pricing of Chinese assets? Are they already reflecting the expected better economic news to come?
I don't think so. I mean, if you look at, you know, if you take the traditional PDE metric, you know, we're still around one standard deviation below average on China onshore, China offshore as well. We had that 2-3 year period of constant selling and shorting due to the regulatory crackdown. So I think positioning is still pretty light towards Chinese equities, and the valuations are relatively attractive. Now we just need the earnings pickup, and then you'll start to see that sort of PDE ratio actually come lower. And I think that will be the real driver for investors to move back in, particularly when you have U.S. earnings dropping on the other side.
And which assets, which markets will benefit when that happens? I mean, we always talk about how the Aussie benefits from better data out of China.
Well, it really depends. I mean, if you're looking at exports, then that's clearly the trading partners. We've already seen South Korea, Taiwan perform very, very well this year on the back of that. And then I think it's a question for if investors do want to move back into directly into Chinese equities, do they look at the offshore space, much more consumer discretionary heavy, technology heavy, or do you go onshore with some of the older economy type plays, steel, infrastructure, manufacturing, et cetera? I think it's a little bit of both. But what we're actually seeing recently is a slight preference for the onshore equities as part of this recovery story.